So today we're going to be talking about the best high dividend ETFs on the US stock market. And we're going to be looking at the main metrics that you have to look at when you pick your own stocks or ETFs. Hello everyone, my name is Alex. I hope you're staying safe. I hope you're doing well. Welcome to my channel where I talk about personal finance, dividend investing, stock market, and what are the best ways to financially secure your life. And remember, whatever I share with you here, I personally do for myself as well. I'm not sharing anything I don't believe in. And if there's something that I don't like or I don't believe in, I'll explicitly mention here for you. So don't worry about that. That being said, you need to do your own due diligence when it comes to investing and decide for yourself what best works for you. And the last point before we start, smash that like button for me. That's gonna help me a lot. Subscribe to my channel if you like what I'm doing. And now we're fully set to start with dividends. Let's go. So today we're going to be talking about the best high dividend ETFs on the US stock market. And all the ETFs I'm about to share here with you were picked with 5 key metrics in mind. The first metric is dividend yield. I'm targeting 4% or more. One thing to mention here is that the higher the dividend yield, the riskier the stock or the ETF is. So whenever you look at the yield, don't only look at the yield, you also need to consider other things for this ETF or stock. And the main thing to compare your yield to is what are the holdings underneath this ETF. And that comes to our second metric, diversification or depth of holdings. We want to make sure that all the holdings of our ETFs are very well diversified between different sectors. The third metric is MER, management expense ratio. And I'm targeting here for MER being less than 0.5%, which means for every $1,000 invested, we don't want to pay more than $5 per year. And if the MER is higher, we also want to see the yield of that ETF being higher as well, because MER is basically eating up the yield from our ETF. But generally, the lower the MER, the better. And the fourth metric we want to look at is share price. And what we want to see here is the share price constantly growing year over year for the last 5 years at least. But I would say that the minimum requirement here for the growth rate is for it being at least twice more than the inflation rate. Because we're looking at dividend ETFs, remember? So they're not growing year over year as quickly as the growth ETFs. But they pay a lot of dividends, which is good. And the final metric we're going to be looking at today is beta parameter, which is the risk of our ETF compared to the average market. We just want to make sure that our ETF is not going to tank all the way to the bottom and still going to pay us dividends when the market has a downturn. And before we dive into our ETFs, I want to mention something for my Canadian friends, is that on which accounts you want to use for holding these US market ETFs. And because we're looking at dividend ETFs, there's one thing to consider here, is withholding tax, which is 15%, which is why the best account to use for these ETFs is actually your RRSP account, retirement savings plan, where there is no withholding tax with US, so you get all these dividends for free, you're not paying taxes on them. The second best account for your dividend ETFs would be your unregistered or margin account, because all or part of the withholding tax of 15% can be recovered through the foreign tax credit. And you don't want to use your TFSA account for this because you're going to be paying this 15% withholding tax for your dividends, which is not recoverable. So keep this in mind. I warned you, so now it's up to you what you want to do. Finally, let's dive into our top dividend ETFs. So the first one is SPHD, Invesco S&P 500 High Dividend Low Volatility ETF. So SPHD is one of the most sophisticated income ETFs, and this focused on just 50 stocks with above average payouts, but also lower share price volatility over the last 12 months compared to their peers. And the holdings are very diverse, all the way from sustainable blue chip stocks like AT&T down to the lesser known natural gas player like William Companies. And this ETF is particularly good for low risk investors. So let's go through our metrics. The first one is yield, 4.89%. This is pretty good. And the next one is MER, which is at 0.3%, which means we're gonna pay $3 for every $1,000 invested, which is not bad for the yield we're getting. The next one is 5-year growth. What we have here is 7.7% year over year for the last 5 years, which is not bad and compares nicely to the S&P 500 growth rate as well. So now diversification. As you can see here, the company is 18% in utilities, it's 15% consumer staples, 12% in French technology, and 11% communication services, and 8% in energy. It's very well diversified, and that's why the risk is low as well. So now getting to the risk level, right? So it's 0.96 which means that it's 4% less risky than the average market. What it means that if you add this ETF to your portfolio, it's going to become 4% less risky than without this ETF. And the final, and I think also important point to make here, is that the dividends paid out every single month, which is pretty good. All right, let's go to the next one, which is SCHD, which is the Schwab Dividend Equity ETF. This one is very interesting because it's one of the cheapest dividend ETFs. The MER is at 0.06%, which is crazy. So it means that for every $10,000 invested, you're gonna pay only $6. Right now, for example, one of the top holdings of this ETF is company Pfizer, which is a drug maker, and it pays more dividends than one of the top blue chip stocks on the market. And this ETF has about 100 holdings in their portfolio. All right, let's go through our metrics. So the first one is yield. It has 4.32%. which is pretty good. And considering the MER is pretty low at 0.06%, we're basically getting the whole year to ourselves. The next one is 5-year growth, and SCHD stands at 14.5% year-over-year growth, which is crazy, which means that it almost outperforms S&P 500, and we're getting on top of that 4.3% dividends. Crazy. Now let's take a look at diversification. So as you can see here, we're at 25% financials, we're at 17% industrial, 16% consumer staples, 13% information technology, and 6% energy. So as you can see, we're actually very well diversified here as well. So this one is in pretty good condition as well. And looking at risk, which is actually at 1.0, which means we're as risky as the whole stock market. And the final one, how often we're getting the dividends. So this one is actually paid out on a quarterly basis, which means that we're not gonna get dividends every single month, we're just gonna get them on a quarterly basis. But the amount is gonna be slightly bigger than every month payment, which makes sense. So the next one is IDEV, which is the iShares International Select Dividend ETF. So I picked this one for a couple reasons. One of them is that it tracks companies outside of US. And this is one of the strategies how you can supplement some existing American stocks and ETFs in your portfolio. So you're going to be less worried about the economy in the US because now you're diversified to the out world as well. And the holdings in these ETFs are actually very familiar companies to everyone else as well, like the British American Tobacco Company or the Royal Dutch Shell. And these stocks are just as stable as their US peers, and they often pay higher dividends as well. So let's look at our metrics. So the first one is yield is at whooping 5.44%. Crazy. The next one is MER, which is at 0.49%, which is pretty high, but it's still within our limits. Now let's take a look at the 5-year growth. It's actually not very high, it's at around 6% year over year for the last 5 years. Still not bad and also within our limits. So now let's take a look at diversification. So as you can see here, we're at 31% financials, we're at 19% utilities, 14% materials, 8% energy, and 8% communication. So it's pretty high on financial sector, as you can see, but still has very good diversification in other sectors underneath. So what about risk? So the beta parameter is at 1.04, which means that it's 4% riskier than the average market. What it means that if you're gonna add this ETF to your portfolio becomes 4% riskier than without this ETF. And I would say this is acceptable. And the main reason why the beta parameter is a little higher than normal is because this ETF contains a lot of small cap companies. So that's why the risk is a little bit higher. And how often the IDEV pays dividends? They're on a quarterly basis. So keep that in mind. All right, so we have a couple more to go. So the next one is PEY, which is the Invesco High Yield Equity Dividend Achievers ETF. So this index is comprised of 50 stocks that are selected primarily on the high dividend and also on the dividend growth year over year. And a couple notes about this ETF is that they changed up all their holdings once a year, but they also rebalance their portfolio on a quarterly basis, which means that your holdings are going to be properly allocated to different sectors on a quarterly basis. And now let's look at our metrics. So the first one is yield is at 4.3% and the MER is at 0.52%, which is pretty high and is actually above our limit. So the 5-year growth is actually at 11% year over year, which is pretty good, and it competes nicely with S&P 500 index. So I think it's worth it. Now let's look at diversification. So as you can see here, we're at 26% 30% financial, 20% utilities, 17% consumer staples, 11% energy, and so on and so forth. So as you can see, we're a little high on financial sector, 26%, but overall the diversification looks pretty good, which comes to our beta parameter, which is at 1.0, and which means there is no added risk. So adding this ETF to your portfolio is not going to change the risk of your portfolio. So now how often this dividend is paid out? It's on a monthly basis. Alright, let's go to the next one, which is a VYM. It's a Vanguard High Dividend Yield ETF. So this ETF measures the investment return of common stocks of companies categorized by high dividend yield, and that helps them to track the performance of stocks that are forecasted to have higher dividend yields in the future. Now let's look at the metrics. So the first one is yield at a 3.19%. I know it's a little bit lower than our limits, but stay with me on this one. Let's take a look at other parameters. So the next one is MER. The MER is at 0.06%. So this is a super cheap ETF to have. You're getting the whole yield to yourself. Now the 5-year growth. So the 5-year growth is actually at 10.5% year over year for the last 5 years. The next one is diversification. So as you can see here, we're at 20% financials, and I would say this is pretty good. We're not a lot in financials. Next one is 14% healthcare. So this is actually interesting because not other ETFs are that invested in the healthcare. Then 13% consumer staples, 10% industrial, and 9% information technology. So I would say diversification is pretty good and there's nothing to worry about there. So now let's look at our risk beta parameter is actually at 0.92, which means that it's 8% less riskier than the average market. So I would say this ETF is really good for a low risk portfolio. Alright, let's look at the last one in our list for today, and I think it's one of the most interesting, and it's a DIV, Global X Super Dividend US ETF. Pretty cool name, Super Dividend. Must pay a lot of dividends. Let's see. But what also is important about this ETF is that for a company to be added to this index, they need to pass two main criteria. One is the low volatility and the other one is the high dividend yield. And that methodology has led them to have a lot of real estate companies in their holdings. And in a bit, I'm gonna tell you what actually happened because of that. So let's take a look at our metrics. And the first one is yield. And hear me out here. It's at 8.02%. This is crazy. The yield of 8% is insane. And let me actually explain a bit what actually happened here. Let's finish out with our metrics. So the next one is MER. It's at 0.46%, which is pretty high, but with this yield is actually acceptable. And let's skip the 5-year growth and go to diversification first. So look at this here. So we have 24% consumer staples, and it's all right. 20% real estate. This is actually pretty good chunk of the stocks of the holdings are in real estate. The next one is 20% energy. This is pretty good. 11% industrial and 8% utilities. So what we see here is that it's a lot in real estate and consumer staples. And now let's go back to the 5-year growth, and hear me out here. It's at 1.1%. So this is pretty low. And why it is low? Because of the last year. Only in 2020, this ETF tanked 22%. And one of the reasons because a big allocation to the real estate. And so I would say that overexposure to certain sectors can lead to these situations like this. So make sure that your portfolio is actually very well diversified and you diversify your portfolio into different sectors. You are not overexposed to some specific sectors alone. And now if you look at the risk parameter, so the beta is at 1.2, which means that this ETF is 20% more riskier than the average market. So this is pretty high. And I would say this ETF can be added to your portfolio or not. You need to figure out for yourself. I know the dividend yield is pretty high and probably pretty attractive, but the risk is high too. So that's what I was talking about in the very beginning of this video, is that the higher the yield, the higher the risk. So it's up to you if you want to add it or not. And my last point on this one is actually that I think right now is one of the best time to buy this ETF and add to your portfolio for at least the next 1 to 2 years. And so I would say I would hold this ETF in my portfolio for the next 1 to 2 years to benefit from the higher yield, and then I'll see how it's going to perform next, if I need to drop it or it's going to be still worth having it in my portfolio. And so that was the last one. We are done for the day. So thank you for being here. Like this video again, subscribe, hit the bell, and thank you very much for joining me here, and I'll see you in my next video. Thank you, bye.